We grow up believing that intelligence is the key to success. If you are smart enough, educated enough, analytical enough, you will figure things out and eventually get ahead. That belief works in many areas of life, but in investing, it can quietly work against you. In the stock market, intelligence alone does not create wealth. In fact, sometimes it becomes a liability, because investing is not just a test of knowledge, it is a test of behavior. Highly intelligent people have a unique strength. They can build compelling explanations. When markets fall, they can construct logical reasons why they should sell. When markets surge, they can justify buying more. When volatility spikes, they can articulate why this time is different. Their decisions feel rational, thoughtful, informed. But behavioral finance shows something uncomfortable. Intelligence often increases overconfidence, and overconfidence leads to more action, more trading, more timing attempts, more concentrated bets. And the data is clear on this point. More trading tends to reduce returns. Year after year, reports like SPIVA show that the majority of professional fund managers fail to outperform simple index funds over long periods. These are highly educated professionals with advanced degrees, deep market knowledge, and full-time access to information. Yet most of them underperform passive strategies. Studies from DALBAR show something similar for individual investors. The average investor earns less than the funds they invest in, not because the funds fail, but because investors mistime their entries and exits. They buy after strong performance and sell during downturns. They react emotionally to short-term volatility. The gap between investment returns and investor returns is not intelligence, it is behavior. Markets do not reward IQ, they reward staying power. Compounding is mathematical, it is mechanical. Returns multiply over time when they remain invested, but accessing that compounding process is psychological. You can fully understand geometric growth. You can calculate expected returns. You can explain volatility drag. But if you panic during a 30% drawdown, the math never gets the chance to work. Compounding only works if you do not interrupt it. And interruption is rarely intellectual, it is emotional. Long-term wealth is typically built through very simple behaviors: consistent investing, broad diversification, low costs, long time horizons, and emotional stability during inevitable downturns. Notice what is missing from that list: genius-level intelligence. The market does not multiply how smart you are, it multiplies what you leave alone. In many cases, average investors who automate their investments and stick to a plan outperform highly intelligent investors who constantly adjust, optimize, and overthink. The desire to be right can be more expensive than the desire to be consistent. The encouraging part is this: emotional discipline is trainable. You do not need a higher IQ to succeed in markets. You need a system. You need rules that remove impulsive decisions, and you need the humility to accept that you cannot control short-term outcomes. Intelligence helps you understand compounding. Patience allows you to experience it. The stock market does not care how smart you are. It does not reward complex narratives or elegant theories. It rewards those who can remain steady when others are reactive. Wealth is rarely built by being the smartest person in the room. More often, it is built by being the calmest. And calmness is not a talent you are born with. It is a skill you can practice.